So welcome everybody in the room and welcome everybody on Zoom joining us for this meeting. I'm Nairi Woods and I'm Dean of the Blavatnik School of Government. And it's a delight to be opening this meeting on unlocking partnerships and finance to build forward, a meeting of senior leaders from the world's development banks to think about what role development banks play in unlocking private finance and unlocking partnerships to deal with issues like climate change. The mastermind behind today's meeting is sitting on my right, and I'll properly introduce her in a moment, but Leonie Lemos is very much the mastermind of this meeting, and which is being hosted under the auspices of the Lehman program here at the Blavatnik School, and the director of the Lehman program, Anna Petherick, and Leah and her team in the Lehman program have done a wonderful job supporting this meeting. So our thanks to all of them as well. So why is this meeting so important? If you Google development finance, you'll very quickly come upon figures that tell you that developing countries in the world need between $2 and $4 trillion per year to avert catastrophic climate change and climate risks. So just to repeat that, they need between $2 and $4 trillion per year. The public funding available to developing countries is a fraction of that. And then, of course, beyond the developing countries, there's the industrialized countries who have by far the highest emissions in the world, who need to address climate change, who also need huge amounts of funding from both public and private sector. So the real question facing us today is, how do we get both public funding and private funding to address the world's, existential problems? And for me, right at the top of that list are the kinds of infrastructure and other investments, technology investments, that enable us to slow and manage climate change, and how we redress the extraordinarily devastating effects of COVID-19 on all the human development goals on which we've been progressing for the last decade, and which in most parts of the world have gone backwards and will continue to go backwards if there isn't better investment. So one of the questions is, what role do we expect development banks to play? And are they playing that role? Because to me, speaking as the academic on this panel, there is an obvious role that we want development banks to play. It's the role for which development banks were built in the first place. And first, it's to go where markets don't go. It's to go where private finance won't go, either because it's too risky, it's too long-term, or it doesn't have a return which can justify private finance. It's some kind of public good. So that's category one, to go where markets don't go. The second would be to go where markets won't go. In other words, to be counter-cyclical. When markets seize up and stop functioning, but long-term human progress requires ongoing investments, we should be using development banks counter-cyclically. And third is the role that public development banks can play in encouraging private finance to go into those areas where it could have such an impact. And the IMF have just produced a paper on the role that they think development banks should play in that, broadening out the kinds of investments, investing in equity, catalyzing private finance into those projects. So those are the kinds of things I think development banks need to do. Now, do they do those things? Sadly, I'm sure with the exception of the development banks here represented, they usually don't do those things. And why don't they do those things? Because the very governments that create them to do those things then stand behind them and say, but we don't want you taking any risks. We want you to prove that you're making profits equivalent to the private sector or nearly equivalent to the private sector. When we're contracting, we want you to contract. In other words, they say, actually, we want you doubling up. with what private finance is doing instead of acting as a complement to it. And so very often, development banks start with these bold ambitions and end up being forced by their creators not to do those very things. And I would love to hear in this opening panel from each of the senior development bank folk we have, whether that is their experience and what it is that could change that experience. So in a way, to open, not so much with a full description of what your organizations do, but rather to really focus on what's one thing your organization is doing that you really do think fulfills what a development bank should do, and what's your biggest frustration about not being able to do more of that? Like, what are the constraints? What's the biggest constraint within which you're working? Enough from me. I'm going to introduce each panelist as I invite them to speak, because I know what it's like trying to remember all these different names at the beginning of a panel. So I'm going to start with Reina Irene Mejia, who's online and will come on screen, I hope, in a moment. Yes, there she is. Yeah. Reina, a very warm welcome to you. It's lovely to see you. Reina is president of the Inter-American Development Bank, which has just recently lost its president, and Reina has stepped in from the vice presidency. Prior to joining the Inter-American Development Bank, she was CEO of Citibank in Honduras. And so she's come to a development bank with 25 years of private banking experience. And Reina, before I have you answer the question about the Inter-American Development Bank, can I ask you a different question, which is, what do you wish you'd known about the public sector when you were a private banker all those years? What has surprised you about working in the public sector?
Hi, thanks, Dean Woods. I am delighted to be here, and let's answer the first question. I wish I had a lot of data that I have in this side of the world when I was in private sector. Development banks have significant amount of data and a lot of initiatives and a lot of knowledge that it can be deployed to the countries that sometimes we don't know that is there. I always seen banking as a development area. Every time that we, as commercial banks, and I'm talking in my past experience as a commercial banker, every time that we develop a project, that we finance a project, it is a development of the country, because you create jobs, you develop the society, you develop employment, and this employment goes to people and goes to families. So actually banking, it is development if you go in the corporate world trying to support the society and the country where you're working. And I always had that in mind every time I recommended an operation, a project for development or to finance. It had to be good for the institution, good for the client, and good for the community where it was going to be. So in my mind, banking was always a development. I saw it that way. What will I know at that time? Some of the development banks were my clients, and I saw them from the other end, from the end of financing them and supporting their funding in order for them to bring the money to the places where the commercial banks couldn't go. What I wish I knew, that we could work more together, and that development banks can definitely be a complement on what the commercial banking is doing. This cannot be done alone. I mean, the development of the countries has to be done with a private sector, the public sector, multilateral banks, and nowadays have a significant role in developing the countries, and also civil society. So this is a combination and an alliance that we must be together.
And what do you feel is your biggest constraint at the Inter-American Development Bank?
Let's see. resources are limited, and we must be very effective and efficient. And effective is that every dollar that we deploy to the region, it has to get to where it's supposed to be for the development of the country and for improving the lives in the region. And we still have a long way to go increasing this development effectiveness. We have started the journey. It has started a long time ago, but every day when you see that, and you mentioned the amount of money that is needed, we need to be very, very, very cautious on the spending, but also on bringing the countries with us. It's not only about money. It's technical development, is supporting the countries for having a fertile environment, to have private sector in the country. And sometimes we do control the part, but we need the countries, we need the private sector of the places. We also need civil society. We need everybody on board. We cannot do it alone. It could be seen as a constraint, but also an opportunity, because we can bring like the trusted advisor to put all the parts together, because our role is go where the others cannot go, is bring that enhancement to the country, bringing all the players together to have the best for the development. So it could be seen as a constraint, but it's also an opportunity. We have this moment, this is the time of the development banks. We must come in and have a much more active role than we did before.
And, so often development banks are described as too slow, too risk averse, too bureaucratic. Often, as I said, because it's the very governments that own them that make them that way. Every one of you on this panel is trying to ensure your bank is not that, to ensure that your bank takes the right risks, is less bureaucratic and more nimble and acts faster. Raina, before I move to the next panelist, could you share one thing that the Inter-American Development Bank is doing that you think shows a way, perhaps to other development banks, of what you can do to unlock the kind of public-private partnerships?
Yes, we have significantly, we have several examples, but talking about being agile and nimble, we've been working on that. We have reduced our time of approval, but not only the time of approval, but also the time of execution, and is starting to execute on a more faster, but also more toggle to what we're supposed to do. Also, as development bank, we support countries in crisis, help them address short-term impacts while focusing on long-term priority. And we have been serving the region for more than 6 decades. And our mission is improving lives. And I mentioned this before, we need to be more effective. So our work includes promoting sustainable development, social inclusion, institutional capacity, infrastructure, and regional integration. And of course, climate change that is big now. I mean, we're seeing the devastating effects that we're having now in the region. Also, gender and diversity are our priority areas. We're the region's leading source of development financing. So we know the region cannot wait. And it cannot wait now more than ever. We have to be agile, and we have to listen what the client needs. And when I mean client, is our countries. What are they facing? What do they need now? It's not what we have and what we want to deploy them. It's what is needed at this moment, and how can we bring these resources, and resources in different manners, not only money, but going with them and supporting them during this process.
And can I just follow up? So, because you've had this 25 years of private banking experience, now sitting in the IADB and trying to persuade private banks like the one you used to work for to co-finance with you, or to finance areas that the bank sees as a priority. What, if I gave you a magic wand, what would you do with it to make that possible?
Okay. work together. I mean, we can enhance, and you mentioned it before, we have to be where the commercial banks are not able to go. We can bring longer tenors. We can bring a little bit more trust on the countries in regards guarantees covering the country's risk. So we can enhance and mobilize more private funding and increase. So we can bring a guarantee of X amount of money. For example, we can, and we have done that in the past with sovereign guarantees for countries, and then enhancing the issuance of sovereign bonds in the market, bringing with us the trust, as mentioned before, as a trusted advisor for the country, enhancing the private sector funding. I think that we have worked at, and we have several examples on working with philanthropic organizations, private funds, and in the market, bringing.
Great, thank you. Now, can I just check from the audience? Any questions to Reina before we move to the next? You're going to get lots of chances to ask questions from me, so do prepare your questions and comments as we go. Yes, do introduce yourself.
I'm Scott, Master of Public Policy at the Blavatnik School. A quick question about, you mentioned some of your development objectives and your mission to improve lives. How do you balance your tangible financial objectives around, say, return on equity against some of your less tangible development objectives?
So Reina, how do you balance the incentive to have a return on equity with the incentive, for example, to raise educational standards in Honduras? How do you balance those two goals? Which one do you give priority to?
The development. Our main goal is to improve lives in the region. And we do have our financial planning. We do have our amount of money that it can be deployed to the countries. And actually our main driver is how effective an operation will be for the country.
Great, and I think we're gonna keep coming back to that question. It's a great one, and thank you, Reina. That's a terrific start for us. Let me turn to the gentleman on my left, who I haven't seen for a while, but I've known for a long time, Leslie Marsdorf. Leslie, South African, served in the South African government as advisor to Tito Mboweni, and then I recall you were restructuring state-owned enterprises. So presumably Eskom is all your fault. No, just kidding. But Leslie brings an impressive experience. He led parts of Barclays Capital as vice chair, ABSA, so private sector, public sector, CEO of Advitech, and then shifted to help build the new development bank in Shanghai, a real experiment in a new multilateral development bank owned by the BRICS, the emerging economies. And Leslie's been there from the beginning, turning that bank into a working operation, although I understand from colleagues in the AIIB that it's in difficult straits because of the Russia invasion of Ukraine and such like. But Leslie, let me ask you, can and does the new development bank do the things that a development bank needs to do? And how much of it is actually doing things that the markets won't do, doing it counter-cyclically, very difficult at the moment if the markets are not letting you lend more counter-cyclically, and catalyzing private finance? And if you had a magic wand, what would you do to help the new development bank do more of those things?
Thank you very much, Neri, for the invitation, firstly, to the school. It's my first visit of this kind to the school. I also secondly want to say that it's a great privilege and honor to be the sole male representative here to give some diversity to the conversation. My history to the school is linked to the very early days. I just recalled, actually, it was maybe 2009, maybe 2010, then Professor Hoods convened a meeting at Davos of other schools, deans of Kennedy School and other schools of government as she was conceptualizing the creation of the school. And I remember that moment specifically because we were out quite late the previous night at one of these, Davos social occasions. And I think your meeting was 7 in the morning. And to this day, I'm a little bit I had to wake up at 6 in the morning to be at the session to discuss the launch of this new school, that was still an idea. So,
and thank you again for being there at 7 a.m.
It has been, the real privilege of my life to move to Shanghai in 2015, July, to be part of a team of 5 individuals, one from each of the BRICS countries, Brazil, Russia, India, China, and South Africa, to create a new multilateral bank. And let me start from the outset by indicating that the bank, although it has Russia as one of its primary and core shareholders, the bank, 1 week after the invasion, on the 24th of February, the bank terminated all operations in Russia and no longer lent to Russia, no longer disbursed to Russia. And I'll explain in a second why that is a critical and important statement to make from the outset. One of the essential elements of a multilateral development bank, which comes from way back in 1944 when the World Bank was formed, is that most of our capital comes from the debt capital markets. In other words, we raise money by issuing bonds on the back of a high credit rating. We have very high credit ratings. In fact, we are the highest rated financial institutions in the world. Might seem like a bit like a paradox that the institutions that are focused on development are actually the most risk averse in the world, because to maintain and sustain a AAA credit rating requires you to be very risk averse, to have some of the most conservative financial metrics, the lowest leverage ratios, and so on. To preserve that AAA rating is important for us because we have the lowest cost of capital, which means that we can raise money from the private sector, from institutional investors, from pension funds, from sovereign wealth funds. We add a spread on top to earn a bit of an income, which goes into reserves, into retained earnings, and over time we have more money for development. To give you an example, the World Bank only had something like $15 billion in total that has been injected as equity into that institution. And it has used that to generate returned earnings of north of $700 billion. This gives you a sense of the power of leverage and the power of multilateral banks as really multipliers of development. Returning to the New Development Bank, the reason why it was such a unique experiment and still remains a unique experiment is because it is one of the newest multilateral banks. We therefore had the opportunity to return to first principles to address where's the possible innovations in the very essence of the business model? What could we innovate and change to make the institutions more effective, much more efficient? And then the number of things which has already been touched on. Raina touched on the first one, which is just speed of execution. How can you make your institution as nimble and as agile as possible to reduce decision-making times? In our case, we put a number to it. We looked at how long does it take from the moment the project is conceptualized to when the capital leaves the door. And it turned out it was between 15 and 18 months if you want to build a rail project or a port. So it takes a year and a half almost for that money to leave the door. So we set ourselves a deadline of 6 months. So we wanted to, between 4 and 6 months, to approve within the New Development Bank all our projects. So that was the first thing we did. The second realization that we came to was that most of the financing, and this again comes from 1944 when the bank was established. Naturally, the US was the biggest economy, 50% of global GDP. That's what the US represented at the time of the Bretton Woods Conference. So the US dollar became the anchor currency in the world. And it is not necessarily the most efficient and optimal way to finance infrastructure using dollars only. So we wanted to craft a strategy also focused on local currency financing, meaning raising pesos or raising kwachas or raising South African rand and on lending in that currency, avoiding the foreign exchange mismatch. When you raise dollars, the interest rates appear very low, but as your currency depreciates, whether it's rand or rupee or ruble, over time, you pay back a lot more. So US dollar appears very cheap because of low interest rates, but it is not always the most efficient way to do it. So the second big innovation for us was to look at greater forms of local currency financing. The third area, which is now the dominant theme of MDBs today, is mobilizing private sector capital. It does not make sense for multilateral banks to lead the charge, for example, in financing sustainable infrastructure today, because there are large components of infrastructure assets that can be funded by the private sector. All we have to do, as Reina has touched on, is take on the riskier parts and improve, if you like, do credit enhancement, improve the risk return profile of a project to make it less risky for the private sector investors so that they can get a bit of a commercial return. So that's the third major area where we started from day one to focus on mobilization of private sector capital. Just to go back to the sort of 1994 construct, and I'll maybe end there, is one of the core elements of the business model of MDBs is that it is anchored around the nation state, what's called a sovereign guarantee. And this really was an idea that John Maynard Keynes was the father figure of. He was one of the intellectual he was one of the masterminds of that Bretton Woods conference. And in fact, the intellectual roots of this model comes back from earlier. It comes back, and it's a very interesting, I think, moment of reflection for people today to look at what happened in 1919 at the end of the First World War. It was the Treaty of Versailles, which was took place in 1919, and Keynes was one of the advisors to the British government at the time. And in disgust, he left those negotiations because he felt that the treaty was focused on really punishing Germany at the end of the First World War. His argument was that when you look at reconstruction, when you look at rebuilding after a war, he really came up with this model of a sovereign-backed loan. So if you want to fast forward to today, 100 years later, when eventually Ukraine needs to be rebuilt, are we going to force Russia to pay the $600-800 billion what will be required to rebuild Ukraine, or do you come up with a different model? And so this idea of a sovereign loan, sovereign-backed loan, which is really at the heart of what we do as multilateral banks, is also something that has to be revisited. And the reason why it has to be revisited, and I'll end here, is something which Neri Woods and others have written about, which is that we need to now look at how do we finance global public goods? How do we finance climate change? You cannot have a sovereign-backed, so if you make a loan to South Africa or Botswana or Kenya or any of these countries on challenges that are global in character, whether it's COVID, whether it's loss of biodiversity, global pandemics, all of these things cannot be financed by a model based on the nation state. The institutions, in summary, what I'm saying that we have built up since 1944 has served us well. It's produced rising living standards over the last 70 years, but there are serious imperfections in the model. And the financing of global public goods is a conundrum that we are currently discussing within the development finance community.
Brilliant. Thank you, Leslie. So much there, and we'll pick it up during our discussion. But there's a question from Christina, who's online, who picked up on your first comment about the need to keep that AAA rating and the fact that that gives some risk aversion to the bank because you want to keep that AAA rating. And she writes, how much does that limit the ability of the bank to invest in development? What would you say?
Very, very good question. So this issue have been under the radar, under discussion for many, many years. A number of academics have done work in this area, but more specifically in 2018, the G20 made this a focus of the studies. They put an eminent persons group together under the former Minister of Finance of Singapore. And most recently, literally 2 months ago, a new report was produced by the G20, which looks at the capital adequacy frameworks of multilateral banks. And just to unpack this sort of very, very briefly, multilateral banks hold a large amount of capital. So when we lend, for example, let's take a commercial bank. A commercial bank, the leverage ratio, how much capital you hold versus how much you lend, the leverage ratio of a multilateral bank is only 4. And we have a trigger level at 3. Let's make it too simple. For every $3 that we lend, we have $1 in the bank, right? So we sit, for example, on a very high quality liquid asset portfolio. I manage a CFO of the bank, $10.8 billion of high quality liquid assets, meaning we have in the bank almost $11 billion. And we hold that money because the leverage ratio, the amount of money that we can lend, is predetermined by the credit rating agencies who, as I said earlier on, the biggest constraint for us is to preserve that rating because we get very cheap funding in the market, which we can then lend. In short, to answer the question, it is the case that the methodologies used by the rating agencies have been way too conservative, and they have been put under the spotlight. And literally next month, when the G20 meets in Indonesia, the G20 countries who are the main shareholders of MDBs, the world, the United States, Germany, France, all of the big economies, will hopefully endorse this report, which will suggest that MDBs be a little bit more risk-taking, that we find ways for MDBs to unleash their full firepower and potential, because the world is at such a deep crisis now. We're still emerging out of COVID. The fiscal constraints of many and the debt distress that many developing countries are facing requires us to leverage and use our balance sheet to the fullest. And the constraints of the rating agencies have been put under the spotlight.
Brilliant. Thank you. So all eyes on the G20, but then also on the credit rating agencies and whether the credit rating agencies pay any attention at all to what the G20 says.
Just to make a very brief point on that, the rating agencies are private companies, as you know, right? These companies have existed for 100 years. Surprisingly, you will see that they also recognize, for example, just give you one little example, there's something called callable capital. And I'll just end off with this. We have what's called equity, paid-in capital, or money that comes directly from the government. In our case, we have $50 billion of capital. $10 billion of that came directly in the form of cash contributions from the government. Then there's another $40 billion. It's called callable capital. And there's more than $1 trillion of this money that is out there. $1 trillion of money that actually is not leveraged at all. It exists because it's a contingent liability of the government, but it's not being used at all. The rating agencies have agreed that callable capital, or that guarantee as we know it, can be incorporated into the capital adequacy metrics. To put it in non-technical language, we will be able to use some of that core. So just with financial engineering, we will unleash more, significantly more. When I say significantly more, I mean hundreds of billions of dollars of new development financing will potentially become available if the methodologies are refined.
Brilliant. So we'll keep our eyes on that. I'm going to come to you for questions after Vivian's remarks. So I want you to think hard in the room and online about what you'd like to comment on. But let me come first to Vivian Popo. It is such a pleasure to welcome you back to Oxford, Vivian. This school did not exist last time you visited us in Oxford at the Global Economic Governance Programme. And in that time, you've become Director General of the East African Development Bank. Vivian also sits on the Board of Directors of the Central Bank of Kenya. She's chair of the Board of Directors of the Kenya Power and Lighting Company, really important vantage point for the head of a development bank. So Vivian, a huge welcome back. How well do you think your institution is doing at unlocking private finance? Is that part of your mission? And what would make it easier and more effective for your institution?
Thank you. And thank you very much for having me here. It's been a while. And it's always a privilege to come back to this Center of Learning and Excellence. With regard to the East African Development Bank, we're fairly, in the family of MDBs, we're one of the older ones. So we are 56 years old this year. And we are established by 4 member countries of the East African community. And soon, an additional one, Burundi, will be joining us. Now, a bulk of the funding that we used is mobilized from the capital markets or from other development institutions. We have in the past raised money from the private sector within our regions, and that has been local currency lending. We would obviously like to do more, and I just wanted to pick up from the discussions we've had about the rating agencies and the impact of the rating on your ability to mobilize resources. So one of our biggest constraints in raising more funding that we actually need for development in the region has been the rating, not just of our bank, but the rating of our member states and the rating of Africa generally, I would say the entire continent, by the rating agencies. So just off of the top of my head, I think the whole continent is in the B band. So either low Bs, below investment grade, or just B, which would be, a low investment grade. And that has an effect on not only the ability to mobilize resources, but the price at which those resources are mobilized. And consequently, going to the international markets, particularly borrowing in foreign currency, becomes quite a big challenge, because once you get the funding in, the price at which you're able to lend a public sector project is very, very sensitive, and it is critical. So we will not be able to say borrow monies at 5-6% and expect to build a dam which is funded at that rate. So that has been a very big constraint for us as a regional development bank. And coming to the issue of rating, which again has been expounded at, I just wanted to clarify the callable capital. We all have callable capital, but the manner in which the callable capital is assessed also depends on the share or the shareholding of high-rated countries. So if you're in a region like mine, where none of the member states are AA or AAA, the callable capital really does not help much. And even if we were to include it as part of our capital adequacy ratio, the rating agencies would discount that amount. So again, it doesn't help the rating, and doesn't help in the resource mobilization. The third challenge is that in order to maintain those high ratings, we're required to place the reserves that we have, that is the capital plus any other funding that we have, in very highly rated financial institutions, preferably in highly rated countries. So what does that mean? All the reserves that we have in foreign currency, dollars or euro or others, have to be in European banks or in US banks that are AA or AAA rated. So that has the effect of exporting out the currency that would have been sitting in our domestic banks and supporting development in our region. This money ends up in London or in New York or someplace else. So for a regional bank like ours, that's a significant challenge because then we are holding all those resources offshore in order to support our rating. But this money would have been better used domestically. Now we are rated investment grade, but it's a low investment grade. But when you look at our metrics, bar the location of our bank in East Africa, we would be AAA. And the reason I say that, without fear of contradiction, is that we are one of the few institutions, a development bank or otherwise, that can actually pay off its debt. So we have more equity than debt. And we've put in that awkward situation because we have to reserve our rating. So it would be really very interesting, and we're watching very keenly the discussions that will happen with regard to rating agencies, so that we are able to unlock all these resources that we're sitting on or holding in order to support our rating, and to allow us to use those funds for development in the region.
And Vivian, how do that it must be so frustrating to be sitting in a region which is being ravaged by the post-COVID slowdown in the global economy, the strength of the dollar, all the problems that we know, and you're sitting on a development bank that's well-resourced, and it sounds like there's far too little you can do with those resources to help your region deal with the crisis it's in. So how do you deal personally with the frustration of that?
No, it's a very big challenge, and that's why we say we're looking at the discussions that are coming up to do with the rating, because that's all to do with the rating of the institution. We would be able to unlock a significant amount of our resources to support development in our region. But I think the report that you referred to from the G20, the initial remarks from the rating agencies is that if development banks were to implement some of the recommendations, it would immediately affect their rating. So it's a conversation that's ongoing. But what we have done is that we've used the resources to maintain our rating, but we have approached the local markets and raised funding in local currency. Mm-hmm. And that's much easier for us to manage. And typically we've raised the money at below market price because of the status of the organization and also the number of instruments that we have in the market. So typically we borrow below government rates, or if we're not able to do that, we have treasury operations that help us to borrow below government rates. And that has helped us to then have a counter-cyclical effect, because then we are lending, particularly to the productive sectors, at rates that are below government or market, and also for very long tenors generally. And so that has been our ability to contribute, counter-cyclically to the kind of challenges that we're facing today.
And it's worth underlining what Leslie and Vivian have both said about the way their institutions have helped countries borrow in local currency. Because this is a little piece of good news in a world where developing countries are facing such a terrible set of external shocks and conditions, that in previous financial crises, they've borrowed in so-called hard currency, they've borrowed in dollars and at interest rates which have become high, whereas now they're less exposed because more of their borrowing is in local currency. So what they're saying there is actually quite important to, one small piece of good news about the resilience of developing and emerging economies in the current global economy. Is there any question to Vivian, or any comment on what she has just shared with us? Yes. Tianyi, do you want to take a microphone back to just so that everyone can hear? Raina, I assume your bank lends in local currency as well.
Yes, and we also offer we have done it with a couple of countries, a de-dollarization instrument where we convert part of their debt from US to their local currency. So we are aware of these challenges, and we are working country by country, depending on the markets of each one of them, to support them on this. So we definitely working with innovative financial instruments to address these needs of a specific country. Yes.
Thank you. A question to Vivian.
Thank you very much. And my name is Chaman Noor. I am doing MPP in Blavatnik School. My question is actually a follow-up on what you've said on the rating. And from my experience of working with financial institutions in East Africa for about 4 years, I came to know that the rating actually, as you rightly said, is a big problem, and it has consequences in development, in investment, in the socio-economic impact of these countries in Africa is quite huge. So I'm wondering if you or anyone have an idea of how we can address that issue. And of course, it has quite a fundamental story in it, and changing the rating metrics will be quite difficult at such a short term. But in the long run, do you see any possibility of tweaking those or making it more contextual, looking into where these banks are working, and also making it a bit more relative?
Thank you. Great question. We'll come back to it. But Vivian, just Leslie put in front of us the G20 proposals. You think they're not going to work? What do you think would work? What would you do about the credit rating agency constraint, let's call it?
What I said was that the initial comments by the rating agencies was that if we were to implement some of the recommendations, the MDBs would implement the recommendations, that would have an adverse effect on their rating. So this was a remark, I think, across the board. Those are initial sentiments. But I think our view has always been that there is a misperception of risk, and therefore a mispricing of risk. So the rating agencies need to look carefully at the risk matrix and how they factor the risk allocation within their methodology. Because as I said, for an institution like the East African Development Bank, which has never defaulted and which has significant resources, we are downgraded several notches simply for where we are. Yeah. And I think those are some of the issues that need to change. I mean, there needs to be a very careful analysis of the risk metrics and the risk pricing.
And it's an old issue. Like for 20 years, people have been saying that there's an unfair Africa premium that the credit rating agencies impose I'm going to come back. I'm going to give you all a chance to think about your solution to that, including people online. We're going to come back to that question with hopefully some answers about how we get the credit rating agencies to move, or how we take them out of the picture if we want to be more radical.
I do have one comment I want to make on
Leslie,
to answer the question. I think the first point to make is that there is a recognition, even from the credit rating agencies themselves, that they play, if you like, in terms of their regulatory function in the capital markets, there is a public good component to the role. As I said, they are private companies, started in late 1800s, 1911, I think Moody's was started and so on. There's definitely an imperfection in the way that capital markets function today, because as I said, no one has jurisdiction over these private companies, right? One proposal, for example, that was made in the Eminent Persons Group of the G20 in 2018 was that maybe the Basel Committee ought to play a bigger role in setting the capital adequacy frameworks of MDBs. In other words, you take away that power that they have. They can then look at, because you can't be referee and player, to use a sports analogy. You can't be on the field, dribbling and wanting to score a goal, and at the same time, you also the referee blow the whistle, right? So what we're saying is that the rules of the game ought to be set by someone else, an independent arbiter, the way commercial banks function. And then you can have a referee, the actual regulator who oversee. So the first point to make is that there is a recognition that these are private companies, but they fulfill a public role, number one. And number two, I think even the credit rating agencies themselves would acknowledge that in the current environment, during COVID, for example, many institutions like Africa Development Bank, they are significantly capital constrained. They battled to find enough development resources to lend to these countries during a time when the world was basically imploding. Why should you be following these ultra-conservative risk matrix when, literally our lives came to a standstill, right? So there is a need to go back, as I said, to first principles. And often people are reluctant to do that because it is quite difficult to go back to first principles where you question the fundamental architecture. And that is what's required when it comes to credit rating agencies.
That's great. So use the crisis.
Yeah, that's exactly right.
Great. So let me now turn to the mastermind of this meeting, Leonie Lemos, who's currently a visiting fellow of practice here at the Blavatnik School. I'm welcoming Leonie back as well, because Leonie came to Oxford over a decade ago as a Global Leaders Fellow, and it's wonderful to have you back here. But in the intervening time, Leonie most recently was the CEO of the Extreme South Regional Development Bank in Brazil, the largest internal development bank in Brazil's regions. But before that, Leonie, in her role as Minister of Finance for Brasilia, led a pretty extraordinary experiment in how to develop an outcomes dashboard and really deliver a budget and outcomes that matched the kinds of development outcomes that the community wanted. Really an astonishing experiment that you've come to the school in an earlier year to discuss. Leonie, in your work at the Extreme South Regional Development Bank, that experience drove you to, indeed to host this meeting and to really think about what role development banks should play and what's required to help them play that role. But do you want to share what your driving motivation is?
To study development banks,
Yep.
and well, that's a question that was not in this list here.
I'm sorry. I like to surprise people.
I know, she's
You can
very
ignore it.
disobedient.
Say what you'd like to say. You're the boss.
Untamable. No, I think that the question is, I've been working in public service for such a long time, for 30 years, and have been in executive leader roles, subnational leader roles for almost a decade. And I haven't been working at the development area. We're always looking at government as deliverables. So the education, so working as a budget secretary, you're looking at the government and in general, so looking at, is everything doing all right? You have to have a balanced budget and at the same time deliver all these services in with insufficient, scarce resources all the time. So going to a development bank after COVID or during COVID. I joined the bank in 2020. It was really, for me, a great challenge for the moving. At the same time, I could see how managerial skills they travel. You use them in government and then, or private sector, and then you use them also in the development bank. But also the possibility that these banks have of having a real impact in life, in generating jobs and improving quality of life. So that's why I got really a passion for it. And that's why coming here, I wanted to understand more, not only the reality that we live in Brazil and Latin America, but what's going on in different banks in the world, because we have this huge ecosystem of more than 500 development financial institutions and banks, but they are of very different maturity, very different models, very different, not that different ownership, because 75% are owned by governments, but still, I didn't know there were development banks not owned by governments. So you have all this variation, and some that work with 9% of multilateral, they have 80% of the resources, but you have more than 200 smaller banks in the last mile that are very close to the local. And these are the ones who are knowing the market as it works. What are the problems? What are the market failures in the cities, in the local markets? And they are very unknown, and they are facing many challenges. Not only those ones, there's very familiar talk here about, rating, about how this is difficult, how the rating of the country, in our case, a subnational, was affecting our rating. And the difficulty of having local currency, I think it's changing, but still too slow. We couldn't get that amount of resources in local currency that we needed. So we were hedging, and sometimes we are not getting, we had the money sitting in the bank and not having clients wanting to face an exchange risk, because in volatile macroeconomic environment or political volatile environments, it's really hard for business persons to decide, I'm going to take in dollars. I don't know what's going to happen. I don't know the inflation next year. I don't know what's the inflation this year. How come I'm going to get a loan for 10 years maturity, and needing and not knowing what's going to happen. So these kind of problems are common, but also all other kinds of problems are very common in these last mile banks, the smaller banks. The lack of technical capacity. It's not the case of BRD. I was very lucky to have a great technical staff. It was chosen by blind selection, engineers, lawyers, accountants. So you have very professional background, but many of these development financing institutions, they lack technical staff, lack good governance. They don't have a multi-level kind of decision about the loans. So we have bad decisions sometimes, or political influence too much. You have to have some alignment of with the governments, but not too much saying which is the loser or the winner of the time, right? You have to have some good sense of the program. So all these problems that the smaller banks have, that's what I wanted to understand here, and put this together also to look forward, to look for the next 10 years, not as much looking back, but looking forward.
That's fantastic, Lenny. It takes us to a final question that I want to ask each of you to answer, which is, I began this panel talking about the $2 to $4 trillion necessary just for developing countries to avert the climate catastrophe. Right? That's just looking at that issue. There is so much talk at every single one of your annual meetings, in every single one of your organization's annual reports, and in all the multilateral development banks about solving this by unlocking private finance. And I remember one year adding up how much private finance was being promised by multilateral development banks, and it was huge. So here's my question to each of you. lots and lots of talk about this promise of private finance. It looks to me like the oasis in the desert that we're not actually moving towards. So why not? What's the one most important obstacle in your organization to unlocking all of this ostensible private finance that's out there that's going to solve all our problems? So who would like to kick off? Leslie, you took a breath.
I'd say one of the first and most important obstacles in mobilizing large volumes of new private capital for sustainable infrastructure and for development is the absence today of a new regulatory framework. So what you have, for example, today in a whole sustainable finance arena is a whole series of, multiplicity of regulatory regimes that exist. For example, there's green standards, green bond standards in the United Kingdom, there's green bond standards in Europe, green bond standards in China. If we want to green the financial and capital markets, we need a much more stronger convergence of regulation so that you almost like you have your traditional Basel rules and your the rules that sort of guide banks. There are very clear directives which imply that asset managers, for example, must direct X% when they do their strategic asset allocation of their portfolios, 15% or 20% or 30% has to go into sustainable finance. Now, this is happening in a very incremental way. The behavior of capital markets has changed quite fundamentally over the last 10, 15 years. Give you one small example. In 2008, the first green bonds were issued, 2007 actually, by the World Bank and the European Investment Bank. Today, that market, the green bond market, it's a traditional bond just with certain green principles attached to it in terms of sustainability. Today, that market is $1.5 trillion strong. So from 15 years ago, today it's more than 1.5 trillion. But 1.5 trillion seems like a large number, but the bond market itself, the fixed income market globally, is north of 100 trillion. So still a drop in the ocean, right? What I'm saying is that we need to green the financial and capital markets, and regulators, central banks, Basel, who regulates central banks, national banking regulators can play a huge role in helping the creation of a more standardized asset class around sustainable infrastructure. So that is one of the big obstacles, I think. And we are moving towards that because last year at COP26, which Mark Carney, who was the former governor of the Bank of England, drove, he really gave strong leadership to this idea that a new regulatory framework is required. And in November last year, we had the establishment of something called the International Sustainability Standards Board. They have just put all the people in place. So they are now working on new metrics, new disclosure metrics, where every firm will be required in a mandatory manner to say what portion of your activities are focused on sustainability.
Terrific. So there's one positive element to move towards. Vivian, a lot of people say, look, the problem is a lack of bankable projects. The problem if you're a development bank trying to address climate is there aren't enough bankable projects. Is that true?
No, certainly not at least from Africa, if I speak generally, and East Africa in particular. I think one of the big challenges, and also what will relate to what Leslie has said, is monetary and fiscal policy in the countries that the majority of the private sector capital resides. So now we know that the U.S. Federal Reserve is tightening, and that has led to an increase in interest rates. And what that has done is to suck out all investment from the rest of the developing world, including Africa, back to the US because the rates are high. The other issue also, again, in terms of regulation is when there are certain premia or certain requirements with regard to investment in developing countries for banks that are based in the US or in Europe. And that, of course, creates a disincentive, because if you're going to lend X dollars into Africa and you have to place X plus dollars as reserves because of that transaction, that has the effect, obviously, of disincentivizing investment into our regions. The third issue is to do with the private sector. I know this is a discussion, and we're always out there trying to identify this private sector and woo this private sector. But the sense we get is that the private sector also needs to be private sector, which means risk, open to risk and open to opportunities that may have a risk around them. But the sense we get is that the private sector would like to be incentivized by ensuring that all the risks in a project have been mitigated, or if not, they've been covered up by government or another agency. So it becomes very difficult to actually put together, say, a project on a PPP basis, because the expectation of the private sector would be that either there's a government guarantee or an institution such as ourselves is guaranteeing or enhancing the government's portion of that project. And we are asking for pure private sector. Where did private sector go? We would want the private sector that actually goes out and is ready to take on risks and is ready to work with us to mitigate those risks so that we have projects that can be funded. So the bankability of projects, or the lack thereof, in my view, is because of the expectation that a project should come really clean, squeaky clean, and properly wrapped with all sorts of guarantees. And obviously that takes time, and there are not many of those. Yeah.
But that's a powerful thing you're saying. You're saying the private sector, would like to take the profits private, but leave the risks in the public sector's hands.
Yes.
And how do you turn that around?
I think one way of doing it is what you touched on already early on, and I think right now, so maybe Vivian already mentioned it, which is that we have to do appropriate risk sharing when you design these large projects, meaning we can, because we are custodians of the public good or stewards of the public good, we can take on the riskier parts. In other words, in the capital stack, you assign the MDBs to be the enablers. In other words, we shouldn't be financing projects. I'm sure right now with IADB, you're having the same conversations. We should be doing less of financing mega projects. Like, for example, New Development Bank, we finance $300–500 million type projects in all of our member countries. We should be putting in a fraction of that, create the enabling environment, the right conditions where the risk return profile is better and more attractive for the private sector so that we can use our capital in more efficient ways.
But Leslie, sometimes governments are saying to you guys, and Raina, they probably say this to you, which is, they say, you must unlock private financing. You must unlock certain amount of private financing. And then do you discover, as Vivian has discovered, that the private sector, the banks you used to work for, perhaps, no, not really, but the private sector is saying to you, well, we're only going to come to the party if you completely de-risk it for us. And so you're forced into this uncomfortable position of the public sector taking the risks and the private sector taking the profits. I mean, does it ever feel like that? Raina.
Well, first, thank you. First, I want just to stress the sense of urgency for collective action to unlock financing, but also, as you mentioned now, the bottlenecks that hinder development. And it was mentioned before that there is a growing appetite for green and sustainable investment, but investors need clear rules, and I mentioned it before: economic stability, skilled talents, and stable line of project pipelines. And I would like to share an example, because not everything it's bad. Actually, we had very good stories to share, like supporting renewable energy laws and regulations in the country. We did this in Colombia, and we helped to modernize the legislation with innovative auction systems that in 2019, it was awarded more than 2 gigawatts of solar and wind energy to private developers. Our work with finance ministries will help build green national financial systems, shift incentives towards sustainability, and better track sustainable investment. And this is what we're talking here. And just in April, with the support of governments like Germany, Switzerland, and United Kingdom, in collaboration with the Climate Bond Initiative, we launched the Green Bond Transparency Platform. This innovative digital tool already covers around 80% of the region green bonds issuance. So for this, we also, need more innovative, and we mentioned it before, more innovative financial instruments. And we have been, and I don't want to sound, everything positive, but I do want to highlight that we've been pioneers in establishing green bond markets through loans, guarantees, anchor investment, not the 500 million at once, being anchor investment and technical cooperations. Today we have to, bring clients to issue thematic bonds, including sustainable blue bonds, social bonds. In fact, just last week, Uruguay issued its first bond tied to sustainability indicators. And we as the IDB worked with Uruguay's Ministry of Economic and Finance to prepare the framework for this issuance that attracted almost 200 investors from Europe, Asia, United States, and from Latin America. And the demand was just about 3 times of what they wanted to raise. They only took 1.5 billion. Uruguay only decided to take 1.5 billion of the demand. So, it takes two in this side when you're talking about public sector and the development bank to provide policy-based also guarantees for debt for nature swaps. And we have done this in a couple of countries in partnership with private funds, with non-government organization. So yes, you are in between, but you have to find this as an opportunity. And also another innovation that it has worked for us and is the incorporation of hurricane clauses because of our region in our public and private loan agreements, not only in public, but also in private. And these clauses will let clients delay payment of principal in the event of a natural disasters. So besides financial innovation and building forward, will require bringing together all the players. So we cannot be put on a difficult or in the spot situation, say you must do this. This is a must for all of us. And that's where it comes the power of partnership. Last year we mobilized around 5.5, almost $6 billion through 188 transactions with a significant wide range of partners, not only one project. And I love that you mentioned that we shouldn't come with a whole ticket of $500 million. I mean, we should use that to mobilize much more. So, extraordinary times call for extraordinary commitments and partnerships across all the sectors. So government, private sector, bilateral agencies, financial institutions, civil society, you as universities with the academia, and you play a key role in building definitely a better future. I mean, the urgency is now, it's not later. We have started, but we have a long way to go to create this. So
thank you, Reina. So Lenny, we've heard some of the perils and some of the possibilities of partnership. What do you think?
Yeah, I'd like to add. Can you hear me? Yeah, okay. I think we have different challenges from the project side. Let's say the clients, be them from public or private sector, some for the bankers and some for the governments, and they're different. So I think that from the demand side of those who are our clients, we do have some problems in Brazil with the lack of good projects, especially in the public sector. If you're going to finance municipalities, for instance, sometimes even the capitals, they don't have engineers to make the projects bankable. So that's one thing that the National Development Bank and we have done ourselves is technical assistance to governments so they can get loans and produce good projects. That's one of our, it's in our mission to provide this kind of technical, and even for private businesses. Because when you're talking, half of our portfolio was big business, and big, just putting this at the same level, big is over $15 million, so it's not that big. It's actually not large, but half of the portfolio was small and medium business, half of the portfolio of the big businesses. But even for the small and medium, we would give technical assistance also to try to, there's a lot of financial illiteracy, especially in small businesses. So we are partnering with the National Association that supports small businesses, the SEBRAE. We are partnering with the National Confederation of Industries because there's, in our case, there's a lack of. So that's one problem. I also think, I really think that for the point of view of those who are getting those loans, those credit lines, if there is economic instability, that's really hard. So we've seen that 2 years ago when our interest rates were 3% a year, that we didn't have money enough. And then suddenly this year, there's the money, the projects are there, but they say, well, let's wait because it's too expensive. Why am I going to get this money now? So this volatility, it does affect the demand side, those who were contracting. From the point of view of the bankers, I think there's one big problem, that's regulation. I think Leslie is very, and Vivian very right on the topic of converging rules. But also there's this debate on should development banks have the same regulation framework as commercial multiple banks, because these are banks that they do have systemic a problem of a systemic crisis. If there is a default in one bank, you do have KfW, they have large portfolio, large banks, but there are a number of banks that they basically access budgets, federal budgets, local budgets, and or they partner with multilaterals. So what's the systemic risk of a small bank that only deals with this? So I think there's also this debate, or maybe not in Brazil, for instance, and that's not mandatory. Each country adapts Basel as they have their own adapted framework. But in Brazil, it's mandatory for everyone. The central bank is quite tough on that. So for literally 500 questions that you have to answer the central bank, I would say 400 would not apply. They will apply to Santander, but not to a development bank that does not issue bonds. So it's completely different. So the thing is, maybe the solution for that is also have adapted regulation framework depending on the kind of bank, the exposure, the level of risk of each one of the banks.
And can I ask you a very different question, Lenny? You've been president of a bank that serves a region of Brazil. Most countries in the world have regions which are desperately poorer than others. So if you take this country that we're all sitting in, there's an aspiration, the so-called leveling up, right? So what can Britain do about the North, which is so poor and underserved? So from your experience, would you say they should build a development bank for the North or not?
They are building, right?
So do you think it's a good idea?
I think it's a good idea to have an agency or a bank. It doesn't have to be a bank, but you have a development agency, some kind of instrument where you can look for development of the private sector. I do think it's a good idea.
So let me pick that up and just say, so what's one thing that the Development Bank of the North, let's call it that for the moment for this discussion, what's one thing it should do and one thing it should not do?
You should look for good governance and autonomy. Because one thing that designers of institutions like to do is that I want to design this way, but then I want to influence in my way. So a good thing is to have this project, this idea, and then you build institutions and good institutions. I think they do have to have good governance, the kind of decision that's not one person, that's derives from a thoughtful way of coming up to results.
That's a big ask. You're saying London should create it and then let it do its job and not meddle every week in it, which is a big ask.
Not every week, maybe every 6 months you ask, because it has to have some control and you have to have some alignment. Because you also see a lot of bureaucracy taking over, the institutions and doing their own agenda. But I think it's a good idea. But the other question was what not to do. That I don't know. I have to think about it tomorrow.
Let me give the audience a chance to put in a last question or two to the panel. Yep. Can you give this gentleman? Do introduce yourself.
Hello, I'm Chirag, also from the MPP here at BSG. I have a question about blended finance. The question is there an issue that donor countries are not willing or able to provide, let's say, grant funding that can further de-risk projects for both MDBs and the private sector? And what can MDBs do to progress blended finance concepts and build understanding both, with donor countries and private sector, and perhaps recipient countries as well?
Sorry, Sharada, let me check that we've all understood the question. So the question is about blended finance.
Blended finance.
And the question is?
I guess, so countries that provide foreign aid, development assistance in the form of grant funding, and how that can be better used in coordination with MDBs, in blended finance instruments, and whether there's issues holding back donor countries from, like, capability or something from actually using those instruments or mechanisms more effectively.
Right, so blending grants made from bilateral agencies with loans made from development banks. Any comments on that?
Charles, I'll shoot over the few initial comments. I think firstly, it's important in this conversation to recognize some of the progress that have been made, so that we don't leave the session with a bit of doom and gloom. Blended finance is one area where over the last 7-8 years, the International Finance Corporation, the European Bank for Reconstruction and Development have been pioneers in this regard. Reina has also referred to financial innovation. Blended finance is one form of innovation where there's been a much more imaginative use of donor money, the sort of donor agencies, if you like, blending that with MDB development finance together with commercial finance. And blended finance will continue to grow. It is still a small fraction because MDBs over the last 74 years of our existence, 77 years of our existence, have been quite vanilla in the deployment of financial instruments. We have mainly provided traditional debt, equity, some form of guarantees and so on, but there's not been the same application of financial innovation that you see in the private sector. So blended finance offers the prospect of that changing. This is also linked, and I think it's very important for me to just touch on one other element we haven't spoken about yet at all, but as part of the backdrop of this whole conversation, which is that there is a huge imbalance in power within the structures of multilateral development banks. The development world, if you like, where the development needs to happen, are emerging markets, where Vivian, myself, Lenny, Brazil, where we come from. But these organizations are controlled by G7 countries. So if you add up the voting blocks, if you add up the sort of the controlled shareholding structures, you need the United States, Germany, France, United Kingdom, Japan, and so on to be in line with if you want to do any reforms. And this was also one of the impulses for the formation of the new development bank and the Asia Infrastructure Investment Bank, because the world has changed quite fundamentally since 1944. But the basic essential construct of how these banks work have pretty much remained in place. And yet the world has changed so fundamentally over the last 75 years. Some of the most dramatic developments have been the rise of China, India, Brazil, and all of these emerging markets. So whatever we want to do in terms of changing the financial structures, whatever we want to do within MDBs, is often not that easy because the institutions are directed and controlled often by donor countries. Leave that at the back of your mind.
But it has limits. I mean, the United States imposed a president on the Inter-American Development Bank, and it discovered tissue rejection.
That's right.
I'm not asking the new president to comment on that. I'm an academic, so I can say things that you're not allowed to say.
Good point.
But do you think that power is shifting in the Inter-American Development Bank, Reina?
Well, as we mentioned before, these are extraordinary times, and it calls for extraordinary commitment from all the parts. And as it was mentioned before, and Lenny mentioned something very important, is a strong governance. And that's a must for every multilateral bank, is a must, but also the partnerships, and not only funds, but Lenny was mentioning technical cooperation, I mean, grants, funds, and these have to be well taken care. The deploy these funds. And this goes back again to development effectiveness. I mean, how are we doing it? Are we deploying this correctly? Are we going with the right partnership? Are we doing with the right innovation? And we have mentioned the capital adequacy framework for all of us, and for all of us is different in the way it is. And it was mentioned by Vivian, because where is the callable capital coming from? And it's something that we haven't also mentioned is like we have the preferred credit status, and that gives us an enhancement even greater to support at the region. So yes, I think things are changing, and not only at the IDB, but I think in all the multilaterals, and we have seen the call that Secretary Yellen made to all of us. This is our time, and this is the moment that we must step in with all that we have to really convey our mission and work towards the development of each one of our regions where we are assigned to. For my side is Latin America and the Caribbean, and I mention it again, they cannot wait. I mean, we have to take out the bureaucracy and go and expedite and having early warning so we can adjust to what the country is needed. We cannot afford to have projects that are not effective, that are not getting where it needs to be, and we cannot just approve without executing immediately. So yes, it's a call for action and for real action, and that has to happen with a strong governance. That has to happen with financial soundness, and resources are limited. And you mentioned it at the beginning, it's a significant amount of money that we need, but money doesn't go alone. And Lenny was mentioning, and that's very important. We must bring help to our countries to develop good policies that will help develop the country and bring and attract private investment. It goes hand by hand. So I don't know if I answer your question, but
no, that's super. Thank you. You have we've got 30 seconds to go, but Vivian, did you have anything that you wanted to add in before I close? A note of optimism about the East African Development Bank.
Yes. I think, as said, this is a difficult time, so we have to face the challenges head on. For the East African Development Bank, we're very pleased with what we've been able to achieve, particularly during the COVID pandemic, because we did then focus on the last mile. We needed to support our communities to be able to weather the storm, and so we concentrated a lot of our resources to the last mile and more or less transformed ourselves into an SME bank, which is unusual for development banks. So we have significant funding lines going into villages and small communities, and those have worked very well. Contrary to the perception that those are high-risk communities and that we would have a high default rate, we actually had a 0 default rate in those areas. And so we were able to address any challenges regarding the solvency of those projects. On the blended finance, this is what we do all the time. I think we need to do a lot more. And I just wanted to borrow from what you said, which is that the times that we are in now call for global solutions rather than local solutions. So if we're going to do climate mitigation projects, or if we're going to do projects that touch on food security, these of necessity must be large-scale, regional, continental, global projects. So the funding methodology that has been used since the establishment of the Bretton Woods institutions, from which our institutions modeled their charters, need to be reviewed, because the necessity would require that we all forge together, just like we did during the COVID pandemic, when the problem became global and we all had to work together. I think this is the time that, as development banks, we will have to work together. Yeah.
Thank you very much. Look, just before we thank our panelists properly, I just wanted to pull the discussion together into, I think, a couple of really key points that have come out. Vivian's eloquently described a world in which COVID, but also the monetary and fiscal policies of the wealthiest countries are literally creating tsunamis, which smaller development banks are trying to navigate, exogenous forces which you don't control, which make it very difficult. But you've given us a really good, compelling example of the way in which your bank for every dollar it lends is having to deposit a very much more expensive dollar into banks in Europe and the United States. So in other words, the financial structure in which we're expecting development to take place really matters. A second point is about the governance of these banks and how much meddling goes on in every bank by the governments that have created these banks, and how that meddling very seldom serves development very well. It tends to make the banks more risk averse. It tends to make them opt for projects not determined by the importance of the outcomes, but by the political vicissitudes of the time. But some really good news by our panelists, the highlighting of the kinds of new instruments that are making new things possible, blended finance, green bonds that Raina underscored, and so did Leslie. The SME bank and the role that the development banks can play lending to SMEs, which your bank did as well, Lenny, under your leadership, and as Vivian has highlighted. And then the hopes that when the world does cooperate, and extraordinarily the G20 is still in some minimal way managing to function, even with the geopolitical tensions in the world at the moment, that this is an area in which, for the optimistic in the room, we can hope for at least some technical cooperation to make the multilateral development bank system work better at this time of such extreme urgency. So all eyes on Bali as the G20 meets and comes up with agreements there. Can I close by having you join me in thanking 4 fantastic panelists and a terrific audience and the organizers of this really important meeting.
Thank you.